Awesome. Namaste and welcome. I'm Mahesh Nandikanti, President, Telugu Association of Memphis. I hope you're all staying safe and healthy during this unprecedented time. And I also request you all to please follow the CDC guidelines to ensure safety of your family, friends, and your entire community. On behalf of TAM board, we would like to extend a big thank you to all the essential workers, including but not limited to our physicians, nurses, other healthcare workers, sanitation department people, law enforcement people, food and agriculture workers, folks who work in the grocery stores, our warehouse workers, truck drivers, mailmen, and many more. All these people have been relentlessly working to make sure we are safe. So please stay home, stay safe. You all may be aware, TAM has initiated a fundraising campaign, COVID-19 campaign, to raise funds. And we have posted this campaign on our Facebook page. The objective of this fundraising campaign was to purchase some personal protective equipment for our local caregivers. And we also wanted to support a few organizations that have been working hard to feed the hungry in our community. So please consider contributing to this campaign. The details of this campaign have already been posted on our Facebook page, and also we'll be sharing some more details on this YouTube live link. From the fundraising campaign, we have raised about $1,600 as of this morning. And I would like to thank all our donors who have contributed so far for this campaign. Till date, this past week, we have received the shipment for the personal protective equipment, which is the face shields. And we have distributed about 75 face shields to our local physicians. And we saved part of them to even share with our law enforcement people. So we will be distributing a few face shields to even the Colorado Police Department. As you all know, COVID-19 is impacting households, communities, and businesses. In a recent survey, 9 out of 10 Americans say that the pandemic is causing them financial stress, with half of them reporting that they're worried about paying their bills and thinking about their financial future. So COVID-19 is first and foremost, it's a public health crisis, but it also has significant impact on the economy. So considering the situation, TAM board has reached out to our local expert, Mr. Sreeni Meka, to talk about his experience and share his insights with you all. So we are really excited about this webinar. We hope, this information that Sreeni will be sharing with you all will help you plan carefully for your financial future. So this webinar is about taking charge of your financial life during challenging times. And before I hand it over to Sreeni, I would like to give a brief introduction of him. So Sreeni is a Tennessee State registered financial advisor at Lakeland Wealth Management. And he has more than 25 years of investment experience in stocks and derivatives. For the past 10 years, Sreeni has been a long-term value portfolio manager at SEC registered. And also, he has been helping TAM advising filing taxes for the past several years, along with Mr. Shankar Rao Pentapatigaru. So Sreeni published several financial articles that were featured in websites, including Yahoo Finance, Street.com, and even the Wall Street Journal. He holds a master's degree in mechanical engineering from University of Texas. He has an MBA degree from University of Memphis, and he's a CFA charter holder. So over to Sreeni Garu. Sreeni?
Thank you, Mahesh. Appreciate it. Can you see me? Can you see my screen? Yeah. Can you hear me? Thank you for wonderful introduction, Mahesh. Really appreciate it. I'm more than happy to, when you asked I'm more than happy to share my knowledge, and especially in these tough days, we all need each other's help, and more than any time. And here, a lot of the people came from US recently. Some of them came from school, and they just finished the college. Some people came directly on H visas and all that good stuff. What you have seen in the life in India is a lot different than what you see here. Lifestyle here is totally different. People get hired and fired in no time. And things are financially not as stable as it is what you see in India. A lot of people have financial assets and fixed assets and consistent stream of wealth, either from farming, either from buildings, rental properties, whatever. That kind of consistent stream you have because you're already existed for so many years in India. But being in US, the life is new, and you go through a lot of challenges. While I was giving this seminar, I'm going to talk about some of the issues. What are the major differences between the lifestyle in India and back in US? So I'll try to cover as much as I can. And all I ask is you guys throw me the curveballs, ask your personal questions, like, what you see financially, what you think about the down market, like, all of a sudden it dropped 30%, it went back 25%, it's going up and down. And a lot of people getting laid off, and unprecedented unemployment. Never had 25 million people got laid off in no time. These are unprecedented time. This is totally different. What we see there is different than what, it may get impacted. You get some people get impacted, some people not, hope not. But things will be like an up and down going forward. But about this disclosure, anything I say recommend, like, investing in securities and all that, they have risks involved, and diversification is the key. And you can read this legal disclosure here. Anything regarding the accounting, legal implications, you need to talk to your accountant or advisor. So this is for information purpose. This is the disclosure I need to make it. See, look, what's the plan, importance of the financial planning? You see that 78% of the US workers live paycheck to paycheck. As mentioned, like, previously Mahesh said, 78% people, they are all financially strained. Nearly 1 in 10 people make 100,000 and above, they live paycheck to paycheck. And this is not the numbers from up in the air. They're all coming from Career Builder, actually Harris poll. They did that recently. 1 in 4 workers don't see, they don't set anything money aside. They don't save anything. 3/4 of the people have debt. And more than half of the workers, minimum wage workers, they're living paycheck to paycheck. That's the reason financial planning is extremely important. Retirement planning process is about what you wanted to achieve, educate yourself, determine how you wanted to be financially, and you get prepared. If something happens, a job loss, like in health issues, death, change in the social benefits, then you got to come up with the plan and implement the plan, and adjust it as once you set the plan. So financial planning is extremely crucial, especially in this country. Now, when you look into the future, financial future, there are a lot of things are going to impact. First one is the longevity. When you retire, how long you're going to live, how long your money is going to last. And second, the biggest thing is inflation. Inflation is the silent killer. It's a disease. We don't even notice, but eventually everybody get impacted. Later on, you got to see the healthcare, estate taxes, withdrawals, penalties, income taxes, local taxes. We all go through. People say taxes and death; those two you can't avoid. So that's what it is. Now I'll show you another slide. How people think about their retirement, what's the reality? And 27 people surveyed, workers surveyed, they retire at 65. But 2/3 of the people retire way before 65. People think they're going to retire at 65, but what happens is it could be any number of causes. It could be health, it could be some other reason. 1/3 of us retired before 60. So it's called a bird in the hand. Bird in the hand in the sense, you save early when you're in early age. So that's the thing. So you got to plan ahead. You don't know how long you are going to work. If you are like late 50s, don't assume you're going to work for a longer time. And you hope we all work for long, but things you never know. The biggest thing is longevity. Longevity in the sense, let's say if you are 50 years old, you are going to live at least 81 years until you're 81 years. If you are 60, expected to live at least until 83. So longevity is the biggest risk we have, when you are retired. So if you are like a 65 years old, the chances of living 80 is a 68%. And chances of living 80, 90 is close to 28%. But if you look into wife and husband, like a family, probability of living 65 years old, living up to 100, if you look into that, living up to 80, you have 90% of chance one of you will be living up to 80. And up to 2/3 chance one of you are going to live up to 90. This is a joint probability. This information came from Society of Actuaries, and these are the people plan all the insurances and for the insurance companies. So those are the mortality. They draw the numbers from mortality tables. So the biggest risk is longevity. The next one is inflation. Inflation is going to impact everybody, irrespective what age you are, what age group you are in. If you look into last year, it's like a 2.3%. And this year so far, 1.5%. But historically, the inflation rate is about 3%. But if you look into these numbers, it's going to scare you. I didn't mean to scare, but actually from 1999 to 2018, the overall inflation, the aggregated information, not aggregated, the cumulative information is 51%. But whereas the earnings from the workers, it went up only 68%. But if you look into the health insurance premiums, they went up to 39%. So inflation is going to impact a lot. But if you look into educational costs, those are even worse, but I'm going to talk them in future. If you look into that purchasing power, these are the true numbers from Labor Department, US Department of Labor. 1994, if the house is $106,000, the same house now is $380,000. By 2044, by the time, 25 years down the line, the same house is going to cost $835,000. That is the inflation, the power of inflation. The gallon milk now, it's like, let's say $3, used to be $2 in 94. It's going to be $7. Same thing, gasoline is going to cost $6 in 20 years. So those are the numbers we got to worry about it. So that's the thing. Whatever you have the money, you put it in the cash and money markets and all those things, they are not going to budge. You need to have the protection for the inflation. So you need to invest to address the inflation. Just to give you an idea, the inflation, if you have $5,000 today, 20 years down the line, the actual purchasing power of the $5,000 is only $2,769. It's going to be $2,000 in 30 years. So what you have, the money, unless you make it beyond inflation, the value is going to erode. Now, here is a case study. Simple example. I just wanted to give you the importance of investing, at least to beat the inflation. Let's say wife and husband living here, like in Bob and Cindy, and they're the rough names up in the air. Let's say their living expenses are $5,500. And down the line, when they retire, they plan to spend 80% of the whatever the monthly expenses, because by that time they don't have to pay the mortgage, they don't have to pay all the college debt, and everything is taken care. So assuming 80% of that is $4,400 per month, that means per year it makes if you adjust with the inflation, like a 1.3 power 15, that's 1.558. So it's going to be $6,855 per month in 15 years, that's $4,400. But if you multiply for 12 years in a year, it's going to be $82,260. So that $82,000 after they retire, let's say they're going to live 20 more years. After 20 years, the amount will keep going, right? Every year it's like, it goes by 3%, 3%, 3%. In 20 years, the last 20th year, it's going to be the same $86,000 is like $148,000. If you add up all those, that means $2.2 million. The simple $4,400 a person spending at current dollars, they need to have at least $2.2 million. Ladies and gentlemen, I think I gave you a good picture of the importance of saving and investing. You think it's a little amount, but when you look into the end of the day, it's going to be $2.2 million. So you don't keep all that money in cash, right? You invest. So let's say you're investing that money and you put the money in a balanced fund, and assuming it's growing 6%, like, let's say 8 to 10% in stocks and 0 to 4% in bonds, and an aggregate, the balanced fund is giving you, let's say 6%. And there is a 3% inflation with that number. So, you put the money, it keep growing at least the 3%, right? After adjusting the inflation. If you wanted to live, let's say $75,000 per year, and you're going to live 20 years after the retirement, you need to have at least $1.1 million cash by the time you retire. Let's say you wanted to live a little bit more modest life for 100,000 a year. And if you want to live if you are going to live 25 years after your retirement, you got to have $1.8 million. You see this, the table, I think you get a big picture on that one. So that's the thing. But here, this will give you a big picture if you are a young professional, or you just got out of college, or you just married, whatever. By that time, you have no financial capital, right? Your total wealth of the human capital is a combination of human capital and financial capital. When you're young, you have no financial capital, but your human capital is the highest at the peak when you are youngest. Because human capital is nothing but your future earnings discounted to the present time. The financial capital is pretty much whatever you have in your pocket. That's your financial capital. As you see in this graph, as you get older and older, your financial capital is going to grow higher and higher. But the human capital, you have highest right after you come at the college. And then it slowly declines at 65. Let's say if you retire at 60, pretty much the human capital ends there. So rest of your life, your financial capital has to cover you, not the human capital. So most of the people, the human capital is going to end at 65, but financial capital keeps growing. So that's, as you get older and older, you keep on accumulating the financial capital. And so that's the graph that gives you a big picture. So there are three types of sources what you can for the retirement income. One, the IRAs, Roth IRA, regular IRA, and other sources. Another one is the Social Security. So the third option is employer-sponsored plans. So I'm not going to cover too much on this because in the previous seminars I did cover all those, but I'll try to touch a little bit on them, and then I'll go back to the educational planning. A lot of people ask their kids are going to college and how they wanted to do, or my kids are in high school, what you wanted to do. So I'm going to give a little bit more time on that one, but IRS and Roth IRS, I briefly cover them, and then we'll go from there. And if you have questions on that one, any of these, feel free to send text message or reach out to the Mahesh, and Mahesh is going to reach out, moderate the questions. For the IRAs, you can contribute up to $6,000, provided if you're in annual, there is an annual income limits. Within that limits, if you are contributing to IRA, you can put up to $6,000 per year, or 100% of your earned income. And if you are above 50, you can put up to $1,000 more. If your non-working spouse is there, she also can contribute exactly the same thing. So married couple can put $12,000. That money is tax deductible given the income limits. The second one is Roth IRA. There's not much difference as far as the contributions are concerned, but the Roth IRAs are tax deferred. You put tax deferred money, and anytime you can take the original investment. But anything after within 5 years, if you take anything growth out of that, then there will be 10% penalty. But after 5 years, anything you contributed and the growth, you can take it out. That's the Roth IRA has a tremendous flexibility. This is called tax exempt plan. So previous one is a tax deferred plan, and this is the tax exempt plan. So once you put the money after tax money, you can take the money after 5 years at any time without any penalties. And most probably most of you know about IRAs and Roth IRAs. Then I'm going to talk about the Social Security. Social Security, most people, you can take the full Social Security benefit at 67. But everybody pretty much qualify for Social Security benefit when you are at 62. But you don't get the 100% of your Social Security benefit, but you get only partial benefit. Once you reach 67, you get 100% of your benefit. But if you delay until 70 years old, your Social Security benefit is going to go up 8% per year. So it's better to wait until 70. And people say, okay, how can, if I wait until 70 years old, how can I survive once I retire at 65? Then your retirement funds, whatever the tax deferred plan, that's where you take the money. And rest of the money, it's nothing but an annuity. You get the money all your life in the Social Security. So rather delay your gratification until 70 if you can. That's the best option you have. People who were born in between 43 to 54, their full retirement is 66. And it pushed up all the way to 67, anybody born after 1967 onwards. So at age 62 for the Social Security, let's say that's the retirement, you're qualified to take the Social Security, that's the retirement age. Let's say if you're getting $1,300, but if you wait until age 70, you get $2,660 all your life, and it is adjusted for the inflation. So that's the beauty of waiting for until 60, 70 years old. Let's say this Social Security system is pretty much honored system. So in 650, there are like 16 people. There are 16 people for every contributor. Today, 2.8 people, close to three people for every one beneficiary. It's like, Social Security money, the money comes and the money goes. They hold it in a bucket and it goes. They're not invested in anywhere. So it's not growing from the pool. Let's say benefits owed currently exceeds the tax collected. In 2035, the Social Security money, if the same rate the contributions are there, it's going to get exhausted. So we need to come up with some other plan to compensate for these expenses. So what I would say is don't completely rely on Social Security. As of now, there is no threat. I didn't mean to scare, but there is no threat at this point. The qualified plans, the other venue is like, your retirement plans are defined benefits plans and defined contribution plans. I'm basically touch base with this, and then we'll jump into the education planning. Defined benefit plans are nothing but these retirement plans owned by the employers, like, all the retirement plans, nothing but it's called defined benefit plan. So employer is responsible for providing for this. And usually it doesn't depend on the participant's ability to save, no investment risk. And basically all the risk is taken by the employer. And if the plan is in trouble, then PBGC, they jump in and take care of that. So that's if you have that plan, it's great. FedEx, some of the big companies, they do. But nowadays, those even FedEx also going away from that plan. But they are pushing that plan back to the employee. You are responsible for the contributions and for your savings. This is where, ladies and gentlemen, you need to save your money. Anything money you contribute to the defined contribution plan that is exempt from taxes and basically tax deferred plan, like an IRA or Roth IRA, this is where you need to put the maximum amount. The maximum amount for $19,000 for 401k now, and $19,500 in 2020, $19,000 in 2019. So if you can max out that amount, and most of the employers, they do match up to 6%, and depends on the company. But take that money, if it's a free money from the employer, and also as much as you can, please contribute to that, to the defined contribution plan. But in this plan, when you are investing, the risk is yours. So you got to invest according to the risk profile here. So the next thing is, sorry, the college costs are, the next I'm going to talk about the educational savings. A lot of people asked about the educational savings, and that's why I'm going to put a little bit more time on here. That's a 4-year college tuition. If you look into that, public school, it's basically in-state. Out of state is going to be a lot higher. School of Hard Knocks, I know how it is. The public school is $85,000. In 2036, it is going to be $141,000. If it is a private college, like, it could be close to $200,000 now for 4 years. That's an average number. It could go up all the way to $350,000. There are multiple ways you can save for the education. The one is the Coverdell plan, also called educational IRA. And the second one is 529 plan. And third one is the Roth IRA. The first one, actually first two are the more related to education. Roth IRA is there, but I'll talk about that. You can put up to $2,000. In George Bush time, until George Bush time, it used to be only $500. And George W., he raised that money to $2,000 per head, per kid per year. But you can contribute up to they are 18 years old. And there is a income limit, $190,000 if you're married filing jointly. And after that, 190 to 200,000, it's a reduced plan. So, but with this money, you can spend that money for even for high school or college or anything. But the biggest thing, then later on, the 529 plan came. The beauty with this 529 plan is you can contribute up to $15,000 per person, per kid. Let's say you have 2 kids, you can put up to $15,000 per kid. But if you're married, you can put up to $30,000 per kid. So if you have a lot of money, you wanted to, like, pass it to the kids, you can put $75,000 per kid if you're single, $150,000 per person. But it's kind of rare case, you don't see that often. But there is you can contribute that kind of money. But once you do 150,000, you can contribute next 5 years. But typically that's the limit. And if you're 529 plan, there is no upper limit, but some states, if you cross beyond 450,000, they don't let you. So the big difference between 529 and Coverdell is Coverdell, you can put only 2,000. 529 has a bigger limits, higher limits. The 529, previously they were not allowed to pre-college. Now they changed it. They gave more flexibility to that. With 529 plan, you can spend that money to the pre-college too. With that, Coverdell now is no longer popular because 529 took care of a lot of stuff. And Coverdell Only difference is Coverdell you can manage, 529 you cannot manage. That has to be managed by the state funds. And a lot of states, they give state tax exemption, but luckily Tennessee doesn't have state tax, so we don't need to worry about it. So good part is people in Tennessee, we can contribute to any state, in any state. So if you are in California, it makes sense to contribute in California 529, but not into other states. But Tennessee, we can go to any state and pick the best plan for us. And the third one is the Roth IRA. Roth IRA, withdrawals are tax-free for education purpose. If you are using for educational purpose, yeah, that's tax-free. But why would you withdraw money from Roth IRA? It's going to hamper your, impact your retirement plan. And when you are applying for FAFSA and CSS, a lot of people ask me about FAFSA and CSS. FAFSA, there are 6,400 schools. They accept FAFSA. There are 200 colleges, private colleges accept CSS. Mostly people apply for FAFSA. But FAFSA, when you're applying, it look for how much cash you have. FAFSA, they come up with the effective financial contribution, EFC number. The lower it is, the more funds you can get from school. So if college is charging you $50,000 and your EFC is like $20,000, so $30,000 you get paid by the college, by the federal government. So to get the EFC, the government looks into the cash, how much you have, how much money you have in the bank accounts, brokerage accounts, all these UTMA, UGMA accounts, and your 529 plans in your kids' accounts, real estate, all those things. But what they don't look into is your principal home. Let's say your home is $1 million, they don't look into that. Your family farm, they don't look into that. A small business you own and you have the assets in it, it won't count. You have 401k, 403b, and SEP IRA, all those things, that money won't count. Life insurance, cash policies, cash value, nah, it won't count. Now here is the catch. Let's say you have a home and you have a couple of investment properties. Then that money is considered as an investment. But if you have an LLC, and if you move those properties into under LLC, that won't count. So that's the catch. But if you look into the FAFSA and CSS, FAFSA is a little bit easier. CSS is more stringent. In CSS, they look into everything. Pretty much, you don't have you don't have you can't hide anything. Pretty much everything is the count, including your retirement funds. So the strategy to minimize, to maximize the FAFSA number, to get the effective, to minimize the effective family contribution number, and your cash is counted towards FAFSA amount. So what you need to do is, if you have extra cash, maybe pay down the debt, pay the credit cards, auto loans, mortgages, whatever. Or you can accelerate your expenses. If you want to put a new roof, by all means do it. Any equity in the home won't count, right? And spend strategically. Okay, here is my 2 cents for attending into this seminar. Here, hopefully you take the couple of points from here. Let's say the tuition is $20,000. In your kids' 529 plan, let's say they have $50,000, $30,000, let's say, and the tuition is $20,000. The first intuition you think is you should pay $20,000 from 529. Rather, you pay $16,000 from 529, and $4,000 you pay with your own cash or credit, whatever. The reason is American Opportunity Tax Credit. I'm going to talk about that. AOTC, that's the beautiful gift from federal government. This one, but there is an income limit. If your modified aggregated gross income is $160,000, so that means if your wife and husband making $200,000 after all the deductions, if you are below 160,000, or you may get partial credit if it is less than $180,000. So the maximum credit for the per student, okay, here is the catch. Per student, you can take $2,500. So that is, you can use it for only for higher education. Let's say your kid is going to college, you can take 100% of the first $2,000 of your tuition, and 25% up to $2,000. So you can do that only 4 years per kid, per student, right? So the other thing is the life learning credit. There is a second credit. This one for any higher education, it can be anybody. It's not your kids, even you can take the credit. But the annual income limit here is $116,000. You can take up to $2,000 tax return, 20% of the 10,000. If you spend 10,000, you can take up to $2,000. If you spend $5,000, you can take up to $1,000. So this is a non-refundable. The previous one is refundable, and this is non-refundable. So here is the credit calculation. Just to look into this, let's say Josh had 2 children, right? Jenny and John. Jenny is a junior at college and paid $10,000 tuition. And her brother John is freshman at another college and paid $25,000 tuition. Josh, the dad, wanted to go to school for a professional engineering license, and he paid $1,600 tuition fee. How much Josh can deduct from American Opportunity and Lifetime Learning Credit this year? The hint is the first one is past $10,000. That means it passed the $4,000 limit, right? So under AOTC, Jenny can take $2,500. Same thing with John. He paid $25,000. That's more than $4,000, right? So he can get $2,500. And for Josh, he also took the $1,600 he paid. So 20% of that is like a $320. So Josh family can take $5,320 as a credit. So if you are sending kids to college, ladies and gentlemen, just look into these rather than paying tuition the 100% from $529. So make sure you leave room for $4,000. So hopefully that helps. So somebody asked me about the mortgage. So, this is the time, the things are going ugly. Interest rates are going down. Let's say you have a mortgage, $3,000 in your home. And let's say you're paying 6% interest for 30 years loan. Right now, you already paid 4 years, 26 years left, right? And by calculating, I think your payment is, when you calculate this, $1,790, $1,800 actually. The remaining principal, if you calculate after 4 years, is $283,000. Is it worth refinancing or not? Let's check what you can do. The remaining payments, because for 24 months multiplied by 12, is $561,000, right? So interest left is, this is the total amount you're going to pay, $560, and reduce that principal $283,000. So interest left is $280,000, right? Now, when the interest rates drop like this in this kind of tough times, you may need to refinance. Look into the numbers. If there is a closing cost, let's say in the hypothetical case, $280,000, and let's say the closing costs are $3,000. That adds the loan to $286,000. Let's say the new interest rate is 4%. So is it worth taking the hit and go for the new mortgage or not? So you calculate the payment. If you have the financial calculator, you can do that. Or if you go to your realtor, real estate agent, or go to your financial advisor, they can do the math for you. So the rest of the 240 payments for the pick with the 1,738, your total payment is $417,000. So the interest you're going to pay for this 417 minus 286, the original loan, so $130,000. Okay, if you look at here, you're almost cutting your interest to half, $130,000. Your loan is paid six years earlier, because it's a 20-year loan, right? And you are saving $147,000. Beyond that, you're saving $60 per month on the payments. So that's what you need to do. Like anything, when you come to the financial planning, you got to look for how much you're spending, how much you're saving. That's what it is. And somebody asked me about the outlook of the market. I think we have ample time, I guess. Yeah, I don't take too long, but I think Mahesh, I'm going to take 5-6 more minutes and then I'll wrap it up. Okay. So somebody asked me about the outlook. So before I conclude, I just wanted to give you a few cents of, my take on the outlook. Right now, first quarter numbers are not that good. First 2 months, economy was good, and third month, they started and everything shutting down. And the first quarter, the GDP is going to drop close to 0.5 to 1%. And the second quarter, it's going to drop 17% of the GDP. This is unprecedented and way beyond depression. After Great Depression in 1929, this is the lowest, going to be the ugliest quarter, second quarter. Third quarter, if things all work well, the projected numbers are around close to 8%. The altogether, IMF came up with the numbers. Actually, they just came up with these numbers. US growth for this 2020 is going to be below 6%. But the outlook for next year is going to be positive 4.5%. So having said that, so the outlook is not that great in the near future. But a lot of people said, though, the market bounced really, really well. But it's hard to say because the unemployment numbers are not so good, and how it is going to be, it's a tough world going forward. The world growth last year, world GDP, entire global GDP went up 3%, but this year it is going to be negative 3%. When it comes to advanced countries like rich countries like US, Germany, and France, the numbers are going to be really bad. The 2020, it's going to be negative 6% in advanced countries. Even emerging countries, that is including China, India, Russia, all those, like around Nigeria, all these countries, emerging countries, even Mexico, all those, Turkey, their also economy is going to shrink at least 1%. But 2020 outlook looks pretty good, but 2020, it's not that good. I know I'm talking like a guy talking about the forecast on the New Year Eve and Telugu New Year, but I'm not a forecaster. But at least those are the numbers came from IMF. But at least I'm trying my best to tell what it is, so that you can take prudent decisions. So when you are investing, don't go too aggressive at this point and plan accordingly. And they also something talking about COVID. A few people asked me about the stimulus package. Good part is you get up to $2,400 on positive side, but not so good news is your family income has to be $150,000 or less, and anything above $150,000 to $198,000 you get partial credit. So every $1,000 you got to subtract $20. Let's say you made $160,000. That's I'm talking about modified adjusted gross income after deducting standard deduction, after deducting your 401k and all those numbers. Let's say if your AGI is $160,000, that means you're $10,000 above 150. That means you get $200 less. So instead of $2,400, you get $2,200. So that's the math you could do. So I think I just crossed the 45 minutes. Is it okay if you want me to go forward, or you want me to continue, or you want me to?
We have about 4 questions from our viewers, Sreeni.
Okay.
I do not know how long you'll take, but you're okay to continue for 2-3 minutes more if you want to wrap up something in.
Sure, that's fine. So it's easy to go up on the mountain and hard to come down, in the sense when you're retiring, you have a lot of benefits, like diversify, you can get tax advantages. When it's coming down, it's tough. When it's retirement planning is the most toughest thing. If you have a pocket, previously I explained the inflation, but if you take the 3% out of your money, your retirement fund, it lasts 50 years. But if you take the 5% rule, if you take the 5%, it's going to last 20 years of your money. And most of them, you have the estate plan. Make sure you have will and trust. Maybe next time I talk about this estate planning and important documents. You need to have durable power of attorney, healthcare proxy, and will, and if possible, make some trust, because it's not in India. Your money, your father's money comes to the son, and son's money goes to the next kids. And there is inheritance. There is no tax. In America, there is no directly, it doesn't pass through. If you don't have will, then it has to go to the probate process. To avoid the probate process is, that means government will take over your assets and they decide, not you. To avoid that, you need to have will and trust. And here, before I count, I wanted to give you, being in US, you need to have different team of people you need to have in your team. But I just wanted to pass through this trivia. Count how many times you see the players wearing the white pass the basketball. Some of you saw my video, but if you saw this, please wait, but let other people enjoy the video. Just give me a couple of seconds. I'll play this one and take.
This is a test of selective attention. Count how many times the players wearing white pass the basketball. How many passes did you count? The correct answer is 15 passes. But did you see the gorilla? This video is This is a test of selective attention.
So what I wanted to say is, just like a gorilla, most of you people haven't noticed the gorilla. So we tie up with our life and we ignore the most important thing, our financial matters. And so please don't ignore the financials. That's the most important thing. That's the reason you need to have a competent advisor. And most three important allies you have to have is in America, advisor, accountant, attorney. The 3 A's. They're all your allies. Make sure tie up with them. It doesn't cost too much to have an accountant, an advisor, or attorney for wills and trusts and update these things. And if you work with your advisor, they can hook you up with the accountant and attorney. Those things are extremely important. And finally, thank you for Telugu Association and all the attendees for attending this seminar. You get the free complimentary consulting with me. Feel free to reach out to me through my TAM or directly to me with the Sreeni at lakelandwealth.com. And also, please do me a favor. Tennessee Securities requires us to collect the people who have attended, their names and contact information. That's the regulatory thing we need to do. Mahesh, please coordinate if you can. Thank you.
Sure.
I appreciate it.
So if you can stop the sharing, we'll move on to our Q&A session.
Okay, sure. Yeah, go ahead, please.
Sure. So first of all, thank you very much, Sreeni. It was a wealth of information. I'm sure, all our viewers watching must have benefited. I've already started receiving some texts thanking Telugu Association for hosting this very informational webinar. So thank you. So I have a few questions from our viewers here, and I hope we are not throwing any curveballs at you.
That's okay.
The first one is, now that the stock market is going down, is it a good time to buy stocks cheaper?
Mahesh, that's a very good question. I always get that answer. Can you time the market? It's hard to time the market. But if you look into the, I'm not talking like a philosopher, but I'm telling you the truth. If you hold the good companies and great companies, and you hold it for long run, thick and thin, and when things dropped and you sold it when the market dropped, like in the middle of March, you're not good for market. That's not the way you should look into. You're looking to have long-term perspective, especially when you invest in stocks. Even after the nastiest corrections, on average, you can expect barely 8 to 10% return with the stocks, and no investment in really you get that kind of returns. You have the commodities, you have the gold, you have real estate, and those are all other alternative investments are there. But the true essence of the investing comes from. I mean, sounds like I'm biased, but that's the statistically, historically, that's the true number. So you cannot time the market, shouldn't time the market. But if you have 401k plan and all the things, based on your age, you can shuffle. Let's say you are retiring like in the next 5 years or so. Try to put more money towards bonds and less money into stocks. But if you are like in the 20s and 30s, I would say 80% of your money got to be in stocks, because you never know how to time the market. Because even super smart people couldn't be able to do the timing. But if you are not good at buying stocks and all that, let somebody else take care of that one. When your 401k money, manage it effectively. I would say when you are below 40, I would say 80% into stocks, stock funds, and 20% into bond funds. If you are between above 45 to 55, I would say 60% into stocks and 40% into bonds. Because stocks, that's where you get the growth. Stocks are the only funds that give you more than inflation.
Thank you, Sreeni. I think you already covered even the second question here. I'll still read out the question. This viewer has given some specifics. So I'm 42 years old and my company matches up to 6% of my 401k. Can you suggest what kind of split should I have between stocks, bonds, and mutual funds?
Yeah, it's a very good question. That's a very good question. Reason being, you get 100% return by contributing to 401k, up to the limit. So if a company is giving you 50% up to 6%, when you contribute 60%, so your 3% money is making 100% of return. So that's the first thing you are getting. By all means, you put maximum $19,000 if you can. Otherwise, you put as much as you can in 401k. So 401k is the first thing anybody has to do. You got to do that. That's the first thing you want to do before investing something else. The real estate is enticing, rental properties are enticing. They all look good. But at the end of the day, don't miss this opportunity. Put your money into 401k and then go from there. And for 40 years old, as I said, I would say close to 75% into stocks and 25% into bonds. But given the forecast, if you wanted to hang on for a while and put most of the contributions into bonds. So I got four people ask, hey, market is going to go down. Why should I save? I'll save when market returns back. No, you can't do that. If there is, let's say, if it is thunders outside, it's cloudy and gloomy, you can fairly say it's going to rain, right? So if you have a perception it's going to be a nasty market next 6 to 9 months, allocate your money into bonds. So the future contributions, just put it into 100% into bonds. When things are getting better, then slowly drift. That's called asset allocation. Allocate more assets into stocks and come up with the 80-20 formula.
Thanks, Sreeni. There's another related question.
Sure.
So I have money moved into my stocks as part of my 401k.
Mm-hmm.
Now that the market is going down, should I allocate it to my other investments?
No.
Question, basically.
That's a wonderful question. Because it's not, see, that's what people do. People juggle back and forth, and that's where people make mistakes. Now, initially, let's say you have 100% into stocks, assuming you have 100% into stocks by December or January, and market dropped to 35%. That means you lost 35%. At that time, you move that money into bonds, you're too late. And it's hard to time. If you are let's say you are 30 years old and you have 30 more years, the nasty corrections get corrected back within 4 or 5 years. So you don't want to do those things, especially when you have a fund. So you don't need to worry less. You need to worry a little less. If you have like a stocks and kind of people like me managing money, we have a lot more things to worry, because that's what we do. We can put more into individual stocks rather than funds. So basically, I'm a fund manager and an advisor. So I take the hit. You don't do that. Yeah, being, as I said, just like I said other video, you do, let donkey does a donkey work, like a dog does a dog work. Let people like me take care of that one. From your perspective, you shouldn't shuffle. Just hang on to that what you have. That's what resilience. Just strong and robust. Don't make any mistakes. By all means, if you have questions, if you're not comfortable asking Mahesh, shoot me. You got my email address, and I'm more than happy to answer. Please don't do those kind of mistakes. And nothing is wrong, nothing is a shy question. Shoot it to shoot me or you, and so we can discuss it and send them.
Right. I'll share your contact information. I know you mentioned it in your presentation, but I'll send out an email thanking you. Probably I'll include the contact information in that.
Yeah.
Just a couple more questions for you, Sreeni. Next one is, do you advise investing in a developing country like India or here in the US?
See, so I'm guilty. I didn't invest in India in 90s, and I put money in here. So if you have like a passive investments, like real estate and those kind of things, there is a risk involved. Unless you have, here you buy a property in let's say in Montana, in city in Memphis, your property doesn't go anywhere. But you buy a property in Dilshuk Nagar and you sit here, tomorrow it goes to somebody else's property. So there is a risk involved. Other than that, if you wanted to invest in the equity market and stock market in India, it's definitely the developing countries are going to be much faster growth. The question of the transparency, how transparent the corporations are, how good the reporting structure. Here we have SEC, Securities Exchange Commission. So every company, they got to do the quarterly numbers, annual numbers, and every day a bunch of analysts watching the numbers and grilling the CEOs. There, you don't see that kind of transparency. Even now, the SEBI is there, but they're not even near close to our SEC. So there is a risk the ample risk is there, but India-specific funds or developing country-specific funds, you could do them. And the fund fees are a little high, but the returns are higher too. So, but given the future, US has a lot of mature companies and also a lot of exciting companies. All the innovation comes from Silicon Valley. I was flying back to India last month. Some couple of people, Germans, they're sitting next to me. And when the discussion came, that's what I told them. Hey, you're talking about Germany, we in Silicon Valley, everything is in here, in our back door. And they didn't like that. But the thing is, everything you see, the Facebook, Google, even advertisement companies, online companies, everything, the innovation comes from Silicon Valley. So on one hand, we have more powerful companies, fastest growing companies. And where is one social media outside Facebook? There is no other thing. Only Facebook is the only social media. It's a monopoly. When you think you see the monopoly, everybody cursing, that's where you want to invest. Microsoft, people used to curse them, yell at Bill Gates. That's the place where you got to invest. Walmart was growing leaps and bounds. That's where you wanted to invest. And Amazon, everybody talking bad stuff about them. And that's where you want to invest. Not that I'm a bad person, you are the bad person. Just because you're investing in the fastest growing company, you are not doing any harm to the society, but you are tagging along. How many, it's a simple example. Google gets the 25% return growth every year. The growth is 25% in profit. Do you get 25% promotion, higher salaries in FedEx or AutoZone or in your company? You don't. Your companies normally they grow 2%, 3%, 4%. But certain companies they grow 40%, 50%. If you can't beat, you just join. If you are, you're a big guy, tough guy. If I can't fight with you, I'd rather go behind you. That's the way it is. So the big ship carry the small ships. So let's join them. That's the beauty of the open market, capital markets in America. So nothing wrong. If you have too much money, don't hate capitalism. Just give the money to somebody else. By all means, I want you to do. That's what Bill Gates was doing. That's what Warren Buffett is doing. I think I answered the question, right?
Yes. And the last thing is, like, some users have been texting saying, can they get your presentation, like, a copy of your presentation?
Sure, I'll pass them. Definitely, I'll pass
So
them.
you want them to reach out to you, Sreeni?
Yeah,
Right.
please. Yeah, and I'll pass it to you. You can email it. Either way, I'm passing. Like, let them reach out to me. I'll tag them. I'm more than happy to. Either way, I'm okay.
Sure. I think we're about done.
Thank you so much, Mahesh. Thank you for inviting me, and hopefully you get a couple of nuggets from my speech. And any questions, I'm more than happy to, just like anything. Yeah?
Sure.
Thank you.
Thank you again. And thank you all to our viewers. Like, this was our first webinar this year, and our TAM board is actively working on evaluating other possible webinars to benefit our community. So we are reaching out to the subject matter experts in different industries to see what kind of new stuff we can bring to you. So stay tuned. We'll see you all in the next webinar. Thank you all for joining.